Mark Sebastian spoke last month, and Ryan is also going to share some thoughts on that. So go right ahead, Ryan.
Great. Thank you so much, Don. That was a really great presentation that we just heard. And so this presentation is going to be a little bit different. It's more of a continuation of our conversation last month with Mark Sebastian of Option Pit. And as you recall, Mark had something that he showed us called his VIX light, and it could be red, yellow, or green. And then when it was red, that meant that VIX really isn't moving and it's pretty low. But when it's green, VIX is taking off, and usually the markets are crashing. So he had 4 different things that he used for his indicator. And I'm just going to review them again with you briefly. And then I'm going to show you the way that I've been using volatility to determine market direction. We're going to go over a few directional trades, not nearly as extensive as the trades we just heard, but we're just going to touch on a few things. And then I'm going to show you a couple different trades that we could do in the volatility products themselves. So just to review, the first thing that Mark showed us was his indicator was this thing. Basically, he follows historical volatility. So here at the bottom of the screen, we have the 10-day and the 20-day historical volatility. And when these things start to pick up, here we're looking at the COVID crash. You can see that the markets are starting to move, and this is basically an indicator to him that it's one factor that goes into his VIX light indicator. This is one of the ones that he considered a minor indicator, but you can see that right here at the bottom of the screen. The next thing that he looks at is basically the correlation of VIX versus XBX. So most everyone here knows what VIX is, but essentially it's the 30-day implied volatility of the S&P options contracts. So that would be something more or less right around this 30-day window down here, which is about at 18.11 is what it's showing on this screen. But if we were to look at go back to the chart and pull up VIX, you can see it's at 1831 currently. Yep. Right there. So during the COVID collapse, we would see just before it occurred, that volatility was starting to rise up right into that moment. That was one of the things that he considered a major indicator. He also looked at VVIX, right, which is the volatility of the volatility. So the VIX volatility products have options. And so here is the volatility of the volatility. So it's the VIX formula applied to the VIX options themselves. So if we go to our all products and we were to pull up the VIX here, the VIX options here have a volatility associated with them. And that's what the VVIX is showing us. So we'll go back to there, and you can see that it was also picking up as well. So that meant that the options on VIX itself were becoming more expensive. And then the last part of his indicator was the term structure. And there's a couple different places that you can see the current term structure. Inside of thinkorswim, you can see the term structure of the various chains right here on the right-hand side. Most all of you are familiar with this. This is not the same thing as the volatility that's at the money, but this is kind of an average. It's actually very similar to the VIX formula, but it's applied just to that individual chain. There's also something called VIX Central, which most of you have seen, and here we can see the term structure. So this is the actual futures contracts that are on the VIX, and of course the spot VIX is shown there in green. And then notice that this is in what's called contango at the moment. And so these futures there's more perceived risk in the longer dated futures contracts than there is shorter term. That's the same thing that you'll see on the options chains themselves. There's more perceived risk going further out in time. Now, in a moment of crisis, you'll see this term structure actually flip, and that's what we see if we jump back to October 16th of 2008. It literally inverts, which is called backwardation. And so again, these are the futures, and so it's not quite the same thing as what I'm showing you here. The futures are on the VIX itself, so it's kind of predicting where the VIX is going to land when that future contract closes. And remember, VIX is 30 days out, so they're two completely different instruments. But if you wanted to actually pull up this information in a chart similar to what we have here, then you can go to the CBOE website, okay? And the CBOE website has the term structure data for the individual chains and puts it into graph form for you. So these numbers here correlate with each expiration, just as they're basically the same numbers as these over here. Now you can actually see the term structure in thinkorswim of the VIX futures contracts, and a lot of people don't know this. If you were to jump over to the Analyze tab and then go to, let's see, I'm sorry, it's the chart screen, and then go to product depth. And then usually when you come to the screen, it'll default to this view right here, which is really not what you want to see the term structure. This is showing you the skew of the various contracts. So this is the vertical skew. So here you can see that the puts, the out of the money puts are more expensive, and this skew is steeper than the out of the money calls over here. But if you were to actually jump over, instead of looking at options, you look at the futures here and then change it to VIX, the VIX future symbol, VX, you can now see this same thing that we see on VIX Central. And VIX Central has this really great historical pricing mechanism where you can then jump to today's date. And the easiest way to do that is just say, show previous trading day, and then get prices, and it'll take you to today's date, and then you can jump back to a particular date. So for instance, we can one thing I'm going to be analyzing with you is this time period that we've just gone through over this past few weeks. And so we can take a look and say, let's look at Friday the 2nd. We'll get prices for that. And then you can jump to multiple dates per graph. And as you advance through, it's just going to paint the next day onto the graph. And here you can see that volatility picked up very briefly there in green. And then it increased even more. So you can actually do this in thinkorswim, which is pretty great. So you jump over here and we can drop down curves and add a curve, and we're going to add yesterday, right? And we can add another curve, and we can actually add the day before. So here you can see that the VIX futures jumped up to the yellow on the 27th, and then today they went down, which is what you see here in red. Okay, so that was a very brief overview, and let me pull up the chat, see if there's any questions yet. Okay, great. Okay, so jumping back, so the four indicators are essentially just to review again, it's the term structure, which I just showed, the VIX in the correlation with the SPX, S&P 500. Those are the two major indicators. The minor indicators are VVIX, and as well as the historical volatility, the 10-day and the 20 days, what he showed in his presentation. And that determines his VIX light. So what I have done is I really wanted to see, I like this historical view of the VIX term structure, but I feel like the VIX futures are sometimes a little far removed, right? So if you think about it, it's you know, the VIX options themselves is the first derivative of price of the S&P. I'm sorry, the S&P options themselves are the first derivative, and then the VIX is a derivative of the options, and then the futures on the VIX are yet another derivative. So there's pretty far removed, and sometimes it's you can have moves in the options term structure over here that will not always reflect itself in the VIX volatility, the VIX futures over here. So the CBOE website is great in that you can also go back in time. So I like to peg it to 245, which is you know, Chicago, but I use, that's basically 3:45 Eastern time. It provides a better snapshot. If you actually purchase data from the CBOE, they will provide this 3:45 snapshot for you. And so we can drop back to the second here. And the reason why I'm showing you this, the 2nd of July, if I go to my chart, so the 2nd of July was right here. So we just had this big up move, and then we had a very small candle here. Something on this day happened that gave me an indication that we were nearing a top. And then I saw the same thing happen over here. And that's what I wanted to review with you today. So if we were to advance from the 2nd, remember the 5th was a holiday, the markets were closed, to the 6th, and we take a look. It's very subtle, but the numbers down here change. So we went from about 16 and 12 to 17 and 13. I'll go back.
Hey, Ryan, sorry to bug you. Could you maybe zoom in on the
Yes.
webpage? Appreciate it.
Yes. So again, the numbers down here for the August contract and the July contract moved from, this jumps from 16 to 17 and again from 12 to 13. So volatility is increasing, and you actually can hardly tell a difference at all on this day. So, but I wanted to provide this historical look and overlay of the various dates, but using the CBOE data, right? Because this is all in the option chains themselves as opposed to the VIX futures. So I built a website to do that. And I use the TD Ameritrade APIs, as well as some of the CBOE and another website called iVolatility to create this website. I'm not going to go into too much details on this, but essentially, if you go to their APIs, this is free. Anybody can use it. If you're a programmer or know somebody who is, it's very, very simple. It's a REST API. And you can drop down and go to option chains or look at price history. If I were to, click on the price history, it's very simple. You just put in the symbols you want. In this case, I'm dropping in SPX and the VIX and hit, send, and it will return the price of the S&P 500 and the VIX as of the close, or as of in real time. So this is reflecting as of the close. So here you can see the close price is 44.01, which is exactly where we are. So let's see. Oh, sorry, the last price. Yeah, 4,400 there. Okay. So then, and then as well, it's 1831. You can also do the same thing for option chains. So if you were to drop in the SPX and say you want a put and the strike you want 4,400, which is basically at the money. And then I want the August expiration, which expires on the 20th. and hit send, you'll get the data for that. So first it's going to give you the weekly SPXW, the weekly, and then here is the monthly right here. And what you want is the mark, essentially. You could also use the last trade for that particular option. And here's the website. So I have shown this briefly before, but I've made a lot of enhancements to it. So the first time I showed it, it looked like this. And all I had was kind of at the money options, which is what you see here. But now I've added VIX data, right? So this is the VIX term structure. It essentially looks just like VIX Central. And I've added the CBOE data, okay? And here's the same historical chart that you saw on VIX Central, but this is on the CBOE data. So I can drop down to the second, right? And get that data, and you can see that the dark blue line is today, and then the lighter blue lines are the previous 2 days. And if I were to go to the 5th, should be the 6th, you can see that it increased across the board, especially here in the front month. Okay. So I have this on my phone. I look at this all the time, and it just indicates for me if volatility is high or low. I can also drop back to, let's see, let's go back to like the 30th and the 1st, and you can see the volatility is dropping pretty dramatically. So this was kind of it was low, and then all of a sudden it pops back up on the 5th, excuse me, the 6th. And then of course, if we were to continue advancing, you would see that it kind of skyrocketed there in the 8th. And the 8th was the day that we dropped pretty substantially right here, okay? Then the market rebounded. And that was the weekend. The market rebounded, and then the 14th, and you see that, so that between the 14th and the 15th, that was an increase right there. And again, that would be 14th and 15th right here. Yep, right here. So this is subtle, and I wanted to find something that everyone can use. So I'll show you what you can use in thinkorswim to get the same types of signals. I'll also go and explain everything else you see on the screen. Up in here in the upper left-hand corner is the S&P 500, where we are currently, as well as the VIX. And then I have the VXX, which is an ETF that essentially just tries to return the same daily return as the VIX. The underlying for that is essentially the futures and trades in various ratios. And then the UVXY is 1.5 times that. So it's slightly leveraged. And then on the right-hand side, I have the daily decay. There's some, this I think right here is what OptionPit is great at. They have a calculator that will determine this for you. And there's white papers online if you want to learn the formula on your own. But you can, so these products will decay over time, and this is sort of the daily decay. I'm still working on this formula. It's not quite exact yet. And then down here are the various, I trade a lot of calendars, or I did at one point. And here's the volatilities of the various months. So if I were to go to TOS, these represents the IVs for at the money. And then here I'm showing the CBOE versus in the VIX volatilities. But the calendars on the right-hand side, this is the price of this month. So like, for instance, August versus September, the calendar's $4,000 essentially between the two. This is telling us that there's 22 days left in the August contract and 50 days left in the September. And then this number over here says that there's 28 days between those two dates. right? So if I were to click on that, it essentially takes us to an analyze graph where we can, take a look at the theoretical values, the deltas, all this fun stuff, just like you can do in thinkorswim. But what I really wanted to know was probably it's more like this. As I'm kind of shopping for dates and calendars, is well, this this particular calendar which expires. If I'm trading the October versus November, there's with 83 days, I can expect over a 30-day period that I'll get a 12% theoretical profit if the market does nothing, right? That's really the number that I wanted to get to, and that's why I built this page. But that's neither here nor there. Really, this CBOE was kind of the driving factor behind this whole thing. All right, now, yeah, that's funny, Michael. Okay, so going back. So let's take, so after Mark's talk, I wanted to come up with something that everyone can use, that we can use as an indicator to determine when volatility was increasing, similar to the VIX light, something that we could just, if you want to use thinkorswim. So we know now that there's the VIX, right? There's also the VIX 9-day. And the 9-day VIX is essentially just the VIX formula applied to an average around 9 days. So it's the options that are expiring, within 9 days or right around that time frame. And we know by looking at the term structure and knowing how it works that this is probably going to be more volatile. We're going to see more movement in these options than we would the VIX itself, right? So I like to use the 9-day, and then of course the VVIX is great, and the VIX futures are great as well. And so if we were to drop over to the chart, now this is what I use kind of every day to trade. And I'm a swing trader. I have a full-time job, so I'm just trying to catch the big swings. I'll put on a trade every few weeks or something like that, and just catch the big moves. But so here in the screen, we have the S&P 500 on the left, and then down here is the 9-day VIX, right? So these we're gonna see movement in the front dated contracts with this indicator, and then down here we have the VVIX. So, and then on the right, I like to have the futures on the screen with VWAP. A lot of times the price will return to VWAP, the volume weighted average price. And then down below is the VIX futures contract, right? So the /VX here. And a lot of times you'll see, for instance, this is a good example where the S&P, the S&P futures contract made a lower low right here, but the VIX futures contract did not, and that can be an indicator that maybe we're putting in a low for the day. Okay, so what do we see over here that's so interesting? So I'm going to zoom out and we'll look at this COVID crash here. So just like we saw with historical volatility, or even with the VIX itself, of course, you're going to see this increase in 9-day VIX as well as the VVIX. And I feel like there's a couple key things that jump out. So this was a pretty big jump right here. And if you were to look at this day, I mean, if you got this indicator right here and you saw that on this day, the 9-day VIX jumped from 9 all the way up to almost 12, and then remained high, you might consider exiting some long positions or getting short, and you would have done well to do so. And then, of course, as price is increasing, you really don't see volatility dropping back down to this level. It's kind of staying elevated. So even though we're putting in some higher highs up here, where the volatility is still staying elevated. And then there's a couple of pops. So we get it down to a marginal low here, and then volatility pops, and then volatility pops again. So we got kind of a signal here and a signal here by looking at the 9-day. And then of course, right here, it really did go all the way up to 16 or almost 17. So on this day, or even this day, you really should have been exiting some long positions and getting into some shorts, because that's kind of what the rest of the investment world was doing, financial world was doing. Same thing with the VVIX. So you can see that the options on the VIX itself are increasing. Right here, so this right here was a good day. It was a good signal, and of course there's others. So we can go through and take a look at a lot of these things. I mean, if you look at almost every single one of these, like right up near the highs, like right here was another one, right on this day, you saw. I mean, if you spotted this and you were to make a move, you would, and then of course it happened again right here, right at the highs. I mean, you're noticing something that a lot of people are not paying attention to, right? And then of course it goes the other way. We can go all the way back to what are we here? This is 2018, right? So you had a pop, another pop right here, and then of course this was a really big spike. I mean, look at that, like that's all the way up to 19, and we're still at the highs, folks. So we could have easily done something to save ourselves some pain. So I mean, it's just example after example. I won't go through all of them, but you should study this on your own if it interests you, and just take a look. This was really interesting here in the beginning of 2018. The market is just going up and up and up and up and up, but volatility is 9-day VIX also going up. And then right on this day, right after this big green candle, this red candle, volatility spiked. And then of course, everything fell apart. Same thing with VVIX. So not to spend too much time on this, but what has been happening here in the past few weeks, basically in July, right here, there was a increase on the 2nd to the 6th. So this right here spooked me quite a bit. And so on this day, I exited some longs. And then we went up, and as we made the new high and volatility did not come off, I actually exited some longs and then entered a short. My short was a bearish butterfly. And then we get all the way down, and I had picked this 42.50 level basically as my target, because that was the previous high from previous swings high here. And so that's where I exited my short, and went long again. And then of course the gap fill was my first target, and I secured some profit. And then with just the last one that I was hanging on to, I took off, I think right here, because a lot of times what you'll see is you won't actually put in a new high. It'll, put in a lower high, and then the market will turn around. In this case, we just kept going. But notice that we're now making new highs, and volatility is still up. So to me, this is still a cautionary indicator, a cautionary time. And so I have not, obviously I have not re-entered. I'm still holding a lot of cash to re-enter. We'll see what happens over the next coming days. We got through the Amazon we got through, Microsoft and what Facebook was today and Google and for yesterday. And of course the Fed today was kind of not much really happened. The markets didn't really react much to it, but Amazon is tomorrow. So we'll see what happens. Okay. So how much time do we have? It's 8:20. Don, I'm just going to keep talking if that's okay with you. I know we usually stop at 8:30, but I have some more to share.
No, I'd like you to please go. This is very interesting material, and the more we can hear, the better. So please go to Don.
Okay, great. All right.
At least go longer if you want.
Okay. So last time I gave a presentation, I was using OptionNet Explorer, and I realized that it's kind of an expensive product for folks, hard to justify to some people. So I wanted to show the Thinkback tool in thinkorswim. It's something we haven't really talked about before. And I'm going to go into some ways that you can directionally trade these things. And then I'll show you some trades on volatility products themselves in the last few minutes of tonight.
Hey, Ryan, real quick.
Yeah.
Can we maybe talk? I'm just been trying to scan your graphs too for areas that maybe it didn't work out quite that way. With a little uptick in the 9-day. I'm looking at maybe that May 31st area. Yeah.
Yep, that happens.
Any comments on that?
Absolutely. Yeah, it can happen. You will see that from time to time. And that's just how trading is. So the in this particular instance, volatility didn't really back down. But it did. But then once it did over here, it's clearly making lower lows, and it's not coming off. So yeah, you will see this. I did the same thing as I was scanning through here to see, another good example might be looking for bottoms. We didn't even talk about bottoms, but since we're here, I'll show you this. We came down. Volatility spiked. We came down again, but this time volatility is much lower, and so that can sometimes be an indicator of a bottom when you're swing trading. This doesn't always happen. You don't always get a 2-day a retracement like this, right? And have the opportunity to then go long. I thought we were going to turn over and put in a pattern like that here. But as you can see, that doesn't always happen, right? It didn't happen here either. So yeah, just careful study and reading the markets is the way to go. I mean, here we did it, right? We came back down, and we still could experience this, right? It broke into new highs, kind of like, so we could be right here today, and then this might be coming, and we'll put in a lower high. We'll put in a higher low on lower volatility. That's kind of what I'm expecting, and that's will be my indicator to go long again. We'll see if that happens.
Thanks, man.
Yep. Okay. So if we were to go to the Analyze tab and click on Thinkback. So a lot of people have not played around with Thinkback. There's a while where it did not work well. It was really poor performance, and the numbers were pretty bad. But I think the product has improved quite a bit over the last year and a half or so. And if we drop back to, so what we're going to look at is a few different trades here. So going back to our chart, we look at the 12th here. The 12th is this day right here. So the days I'm going to pick are the 12th down to the 19th, and then up to the 26th. The reason why I'm picking those dates is because the 12th is a Monday, and then you have basically a week, and the 19th is a Monday, all the way up to the 26th, which is also a Monday. So it's really, and there's also options that expire on Mondays, weekly options, and so it's just really easy to set up the trades. And there's there's 5 red days followed by 5 green candles. I know that the pricing isn't exactly the same. We didn't return all the way to exactly this level. We went a little bit past it, but I think we can compare some of the various trades using Thinkback here today. So the way you use Thinkback is you go up here to the top right hand corner, you choose your date. Here I'm going to choose the 12th, and this gives you the pricing for the 12th. It's nice in that drop back to the 11th here, and it updates pretty quickly. But in any case, the Monday was Sunday. Make sure I got fresh data. 1 second. There we go. Okay. So what we can do is you can buy anything in here. Now, one thing you can't do is look at it on an analyze graph. You could still put this same trade though into the analyze tab, the risk profile, if you wanted to, and see what these things look like. So if we were to trade a vertical, a put vertical, and we wanted to, let's just say that we purchased the 4,400 put all the way down to, you say our target, like I said, was 4,250, for instance. That this down here will show you the profit, what time of day. So this is a snapshot. I believe it's at its end of day data. I don't know if they're using a snapshot that thinkorswim or TD Ameritrade took, or if it's a snapshot that they purchased the data from CBOE. And I'm not 100% certain if it's the 4 o'clock snapshot or the 3:45 snapshot. That's something I need to investigate. Yeah, I'm hoping it's 3:45 because I've seen these same numbers in some of the other products and some of the other trading tools like Sterling Vol Trader, and the numbers are the same. So I would assume that they're probably purchasing it from CBOE, but you never know. Okay, and then here's the date that we're making the trade, right? So on the 12th. So if we want to say, okay, on the 19th, we would like to sell this vertical, right? I can sell it on the 19th, right? And so that pulls in the prices automatically. I don't have to mess with any of these other dates or anything. It's pretty nice. And this is a profit graph. So you can see on the left-hand side in yellow what the profit is. And so the profit on this trade was $7,000 return, and you can see that it was $3,000 debit with the $10,000 credit, so $7,000 return. Now clearly we're pinning the market here. This is probably it'd be challenging to actually do this in real time, but I'm just trying to show you how to use the tool, and we can compare a couple different strategies doing this. So for instance, if we were to look at a butterfly, since we just talked about butterflies, yeah, so that was that's over 200% return right there. If we were to look at a butterfly, and there's all sorts of different butterflies you can do. I'm just going to do a standard broken wing butterfly, and let's just make it easy and do them about 100 strikes apart. So this is a bearish butterfly. What this would look like for you folks who would like to see it is, let me go take a look at a butterfly here. And it's nice because we're basically back at 4,400, which is where we were on the 12th. So it makes it easy to visualize. I'm sure that the volatility is not the same, but it's from a pricing standpoint or from a risk graph standpoint, it's easy to visualize. So I plugged in here the 4,250 right here, and this bearish butterfly would basically have its maximum profit on about that date, and we're expecting that at about that price, and we're expecting that this would happen about within a week is which you might expect. So this contract is wrong. I probably would want to pick something a few weeks out. So this is August 11th. Let's see here. Oh yeah, there you go. Okay, we're good now. Yeah. So the second. So if we were to go to today, it looks like this. And then as we go all the way to the to a week from now, which would be basically the 4th, it would look like this. So in Thinkback, if we were to put on this trade on the 12th, and let me drop back down here, and then create the opposite trade on the 19th to sell, we have basically gone from 1840 to 45.75, which is about 150% return on your max margin there. Now we can also, of course, trade this the other way, going from the 19th up through the 26th. Before I get into that, I wanted to show a calendar because I do trade calendars. So if we were to buy a calendar, and suppose this calendar, we wanted it to be, our target was 40, let's see, 42.50, right? So it does well, but not as well as you might think that it should, right? Can anybody tell me why the calendar doesn't do as well as some of these others? So this is only, is that right? Let's see, 42.50, 42.50. Oh, I need to change these dates here. I believe we wanted the 26th and the, maybe we go to the 9th potentially. Oops. There we go. Okay. So, so 15.95 and 31.25. So this is almost 100% return there. Clearly it wasn't 200%. It wasn't 150%. It didn't do as well. Does anybody know why? It's because of the term structure. So the front month contract that we're selling in July actually went up in the volatility, went up in value as we went down, as S&P 500 went down, right? So it went up, the volatility went up, right? IV went up. And then, I mean, obviously the back did as well. And of course there's delta in this trade. So as price is moving down, it's coming into our, 42.50 target. So we're definitely, it's definitely profitable. But it's not as profitable as it could be if we were already in backwardation and then moving back into contango. So what I mean by that, from a risk graph standpoint, just for clarity, is, well, I can use my my trusty little tool here just to pull a calendar up really quick. So let's just jump to this one here, and I can copy this trade, and I'll copy it and go to the risk profile, and I'll paste it in, and then I'll analyze this. Okay, so here's a calendar. Just these dates are a little different than what we're looking at in Thinkback, but it's just to prove a point here that if the volatility, and I guess we were trading something at 42.50. Right. Yeah. And let's go back to today. Okay. And change the price. There we go. The risk graph is not updating here. In any case, if we were to, I'm sorry, I'm looking at the wrong one here. Sorry. There we go. All right, and we'll go to today's date. And then so here we're trading directionally that the market's going to go down from 4,400 to 4,250. But on the way down, remember the volatility of the near dated contract is going to increase faster than the volatility of the far dated, long dated contract. So you know, so the one that we're selling, which is in September, you know, it might go up you know, 5 vol points, whereas the October may only go up 3. Okay, and then all of a sudden it just crushes the profit tent, and it crushes our T+0 line, right? So, you know, the ones I was doing in Thinkback weren't this far dated; they were a little bit closer in time to expiration. So this effect, it was more so gamma was actually taking hold pretty strongly. That's why it was still profitable. But as you can see, if the volatility changes now, if on the way back up, the exact opposite can occur, right? So let's suppose that we're in this kind of period right here, and we want to go back up to what, 4,650 or something like that. So we're currently at 4,400, and we're thinking the market's going to rebound, and we're playing it in this direction. And we're going to reset our vol price here, and we'll reset this. So here we are today, and suppose we think the market's going to go up. So we can train this calendar in directionally by placing it above the market. And then, of course, if we're currently in backwardation, suppose we're at a market at a low today, which we're not, but we think the market's going to go up from here, then you can expect this you know, potentially to drop by, you know, by 5 vol points potentially, whereas this one will drop by 3, right? And then you've actually increased your profit potential by trading with volatility rather than against it. Got a question online. Do you wait it out to have the front month vol drop as XPS stabilizes, hoping to profit more even if XPS goes up slightly? So I actually don't trade calendars if I think the market is going to go down. But yes, if you are in a calendar, in a position, and the market does drop unexpectedly, you can certainly, if you're can wait it out and for volatility to correct, the profit will come back, especially if you're under the profit tent, and then you can wait it out. And I have done that before. I know Mark does that all the time. Hope that answers your question. Okay, so this is sort of the concept. If you were to trade the calendar going the opposite way in the Thinkback pool, right? Suppose now instead of, we'll trade on the way back up. So we'll start on the 19th and we'll go up through the 26th. So we'll move or advance our date here to the 19th. And we'll go 2 weeks out. And we'll buy a calendar. And we'll change, we'll go to 20, this time we'll go to the 16th. Right, so the second, which is 14 days out, to the 16th here. So we'll go ahead and, you know, we buy that one, and then we, but we want to put it at our target. So our target would be, instead of, so we're currently at 4,250, our target would have been 4,400, back up to the previous highs. Or in this case, I guess I said it was, you know, this date here, it doesn't really matter, the 26th. So you could actually peg it at, you know, 44.25. That probably wouldn't be your target, but just for the example's sake here. And then we want to create the opposite trade, and we're going to close that on the 26th, right? So here you can see our profit go from, you know, it was 1,700 on sorry, $1,700 on a $700 trade. So 17.7 to 25.20, that's about 2,025%. I'm sorry, 225% return. So here is a, and then of course you could do, oh, I didn't even talk about back ratios. Back ratios are a great way to trade directionally. If we were to purchase a back ratio on this day, you could, is everyone familiar with what back ratio is? Sure, most of you are.
I suspect some are not, Ryan. If you could,
some are not. Okay.
Yeah, if you could explain it briefly, it would help.
Sure. So if we wanted to buy a back ratio, we could do something like this. Basically it's a 1x2. So in this case, we're selling the 4,400, and then maybe we'll buy the 4,300. So it looks something like this. So for about $390, we can get into this position. And what this will allow us to do is when volatility increases, suppose volatility increases, by 10% or something, I don't know. You can see that the T+0 line raises up dramatically. So back at this $250, I'm sorry, back at our target right here, if volatility increases fast enough and quickly enough, then not only do we have delta in our favor, but also gamma as well, or beta, excuse me.
Would you always buy in the near month or a near week?
Let's see. So that's 14 days out. I mean, a lot of times I've done these all over the place. You can actually get yourself into trouble. So if you don't know what you're doing with back ratios, because you have this valley of death in them. But the and what I mean by that is if the market just kind of slowly creeps down and time increases, time passes, you'll see this valley of death happen, and you can lose quite a bit of money. I mean, the margin on this for a Reg T account is 10 grand. Of course, with portfolio margining, it's nowhere near that. It's around, I guess, $2,000 or $3,000. But so if the market just creeps down and time passes, you could wind up down here. So you also need to choose your time frame. And this is where careful study comes in. So if 2 weeks out, or maybe 4 weeks out, because you want to have that gamma in the position to and the Vega as well to juice the trade. So if we were to, for instance, what is this? The 20th would be 2 weeks out, or sorry, 4 weeks out. And let me go back to today and unlock our pricing. Oh, does this not? Oh, I got the AM, excuse me. Messed up. Weekly. Yeah, there you go. So I don't know. I've done them at 2 weeks. I've done them at 4 weeks. I probably wouldn't do them long, further out than that. I'm sure there's other people on the call that have a lot more experience with back ratios than me. I've won a lot of money with them, and I've also lost a lot of money with them. So be careful. And then there's different ways that you could finance this trade. So we won't get into that today. It's a little bit more advanced, but you could there's ways that you could put this on for free, potentially. Okay, and then of course, if you do have portfolio margin, you could also do an inverse calendar, which would basically create the opposite effect of what I showed earlier. So when volatility increases in the front month rather than it hurting your calendar. Instead of buying a calendar, you would sell a calendar, and then that would actually help your trade. But again, you need portfolio margining for the most part for that, or you need to use trade the options on the futures to take advantage of span margining. Yes, someone said it looks like Thinkback's poor man's backtest engine. When you can purchase the 1 minute intervals from CBOE since 2004. That's right, exactly. Yep. And yes, I do plan on buying that. I've actually purchased a lot of data, historical data myself, and written a few backtesting engines. And so that's another reason why I'm probably going to just stop paying for Option Explorer and just write my own. And this person, it is ChimeX, is saying that they're going to purchase from CBOE data shop. Yep. And share the cost. Yeah, I don't know if that's legal, but yeah, you can email me. Okay. So back to Thinkback. So of course you could trade the back ratio, and it actually does provide a pretty substantial return. So here's, does everyone see this? So here's the various things that we went through in the pricing. I didn't actually pull up the back ratio, but this is what the end result would be. It actually performed the best on the upside and the downside, ironically, but you have to be careful in how you trade it. I would say that the calendar did, one thing I wanted to point out, the calendar did much better on the upside. It was actually, of these three, which I would consider safer trades, the calendar actually performed pretty well on the upside because that the volatility was working in our favor, whereas it performed the poorest on the downside. And then the butterfly, I think, is a great trade. I actually really enjoy trading butterflies. I have for many years now. I don't like trading verticals. They just cost too much, and the risk return ratio isn't that great. So I prefer calendars or butterflies personally, and the back ratios from time to time. But I know a lot of people in our community trade verticals. So there's nothing wrong with that. All right, and then last but not least, volatility products. So there's a couple different volatility products out there. If I were to take a look at the VIX here, you can actually trade the options on the VIX. So I have some options here in the August expiration, and then I mentioned well, let's just start here. So the VIX right now is around 18. And we know that in thinkorswim, we know that by looking at VIX Central, that the futures are above the spot price, right? So over time, the front month contract is going to converge into the spot price. And if the market stays the same, basically stays neutral, or goes up, then VIX will probably remain down there at 18.3. And that means that this particular option should drop down to meet up with the spot. Spot might even be lower by the time expires in August 17th rolls around. Now that's if the market is sideways or up. Now, of course, if the market drops, then we could end up in a backwardation situation where the spot is above, and then this futures contract is converging up into a higher number. But assuming that the market is going to go up, one trade that you could do is pretty easy, is to basically come out here to any one of these dates, and you can just buy a put. So you can just buy a single put here, and we'll analyze what that looks like, right? So I just arbitrarily chose the 18th, which is basically at the money. Let's see, what date are we on here? Yep, so let's, so this is the August 18th, which is about 20 days to expiration. Yeah, so these dates here, these options are actually on the futures themselves. Like these options are not on VIX, just to be clear. So this August 18th in the AM expiration is on the August, the futures contract that expires on the 17th. Does that make sense? And same thing with this one on the 14th right here. So when you're trading these, you're basically trading the future. You're not trading VIX. So just remember that. So so if a lot of times VIX will drop, but if the future doesn't drop, then your option is not going to, your put option is not going to improve in value. Okay. So just be aware of that. And then of course, if you want to hedge this, you could trade something like a vertical on the call side. Right. And this is probably not what I would do, but you know, you could pick something up here at I'm sorry, and sell buy the 31st, something like that. Okay. So if you think that the market is going to drop this, then your put will increase in value. And so basically we have a synthetic strangle here. But if the market is going to basically go up, then the VIX is going to go down, and then your put will become valuable. And then of course, if the market were to crash, then VIX will spike, and then your this side of the trade will become profitable. So this is just a synthetic strangle using a put and a vertical. You could actually turn these into butterflies on either side if you wanted to. It's all different things you could do. You could do this in the various products as well. So you could, there's VXX, which is the ETF, and there's lots of positions over here. Most of these positions are option pit positions, so I'm not going to show those. But this is basically the concept of what a lot of their trades are like, which is what Mark talked about in his talk last week. And then there's UVXY as well. Okay. So what other questions do we have?
I got one. You said if sometimes the future would not reflect the movement of the VIX. In other words, your option would not gain value. The VIX fell, but the future did not. Mm-hmm. Why is that? Why would that be the case?
Yeah, so VIX can move independent of these futures. So these futures contracts are just the price of it's just the market price, right, of what people want to spend. So you can hedge your portfolio using the VIX futures. It's kind of interesting that the ES futures are actually what are they like? I guess they're half of the S&P of the SPX, and then of course SPY is a tenth, correct?
Right.
And then, but VIX is a little bit different. The VIX future, if I get this right, if I remember, is I think it's a 100x VIX, and the options are only 10x VIX. So so VIX being such a small product, only at 18, the futures actually control more than the options, right? So if you want to trade big, you would trade the future.
Yeah, plus the future should ultimately be more authentic, because while the ETPs can collapse, although we don't think the VXS will do that, we hope that the liquidity of the SP contract itself should be better.
Yeah, so that's why you see, you know, the VIX future going up and down throughout the trading day. It's because people are actually using it as a hedge as well. And of course, all the ETF products are trading the futures. I mean, it's a really crowded product.
Do they base most of their positions in the futures?
Yes, yeah, all of the ETF products, the volatility-based ETF products, for the most part, they have to trade the futures in order to. I mean, that's what their formula is based upon, right? So it's a combination usually of the first 2 months, or depending upon what the ETN is representing.
I hope other people will ask some questions. Just feel free to either type in the transcript or turn on your mic. But meanwhile, let me ask, did you looked at Sterling Vol Trader? I think you mentioned, do you like it?
I do like it. Yeah, it's a little bit clunky. I think that there's some interesting analysis tools on it. If I was with Interactive Brokers, I would probably use it over the IB's tool. But yeah, Sterling Vol does seem to be promising. I think we talked about potentially getting somebody on here.
Well, we can do it. Yeah, I mean, if we'd have some good interaction with them.
Yeah, yeah. You actually do 3D analysis, so you can put on a trade and then look at it. So on the risk graph here, you could actually click it and drag it sideways, and you could look at the day steps, right, on the graph, on the same graph as the T+0 line. So in order for us to get to the day steps, we have to do this, right? You can also do vol shocks with Sterling Vol Trader, which is kind of what we were doing over here. But you could do them. You could show them in increments of 10% vol shocks, etc.
Now there's this the CB. It's either the CBOE or the CME has a version of Vol Trader that is 100 a month. It's a stripped down version, but it's not. They have that version, so that's another one we could look. I mean, it's really the same thing, but it's just cheaper.
Yep, exactly. Yeah, you're talking about the one that's on the web. That's all web based.
I guess it probably is.
Yeah, that's Live Vol Pro. Yeah, it's a pretty neat product as well. I think exactly. Yeah, thank you. Live Vol Pro. In fact, Sterling Vol Trader was Live Vol Pro. It was bought by Sterling.
Yeah, there's a whole bunch of there's several different versions of it because it was originally purchased from, and so on and so forth. And CBOE, I forget whether it was CBOE or CME, one of the two, had rights to it, and they sort of still do. And IB has another discount and another version, and it's just very complicated. You said Bearish Butterfly. Is it John Locke's Bearish Butterfly, or is it just your own version of a Bearish?
Oh, it's just a butterfly, a butterfly below the market. Yeah.
Not
necessarily. I mean, when I trade butterflies, I do it in all different ways. I just, for the example, I just showed just the butterfly that was below the market, a standard butterfly. I call it a bearish butterfly.
But, no, it is. Absolutely. It is a bearish butterfly, but I just didn't know which one you're referring to.
Yeah, no, not John Locke's trading strategy. I don't use that. Although I think I do use a lot of the techniques that he's, taught over the years. But no, I don't follow the system.
Yeah, well, I mean, his bearish butterfly, I think he's basically averaging down. It's the main thing, and well, I'm sure there's more to it than that. So, who else has some questions? Do you have the impression that now that you're into the volatility, which sort of gives you another handle, another angle on the market, because it's tied right in there with the S&P that everybody trades, and yet it's sort of coming at it from a different angle, and with, as you mentioned, very large participants, namely the ETP people and the institutional traders. So there's a possibility, it seems to me, of discrepancy in market viewpoint between, or inefficiency, if you want, between the pricing of the volatility products and the S&P itself. And that's perhaps what you're trading on when you, with some of these trades. Do you think there are inefficiencies or systematic mispricings hidden away? They're not necessarily all obvious in the pricing of these, in the curves and all the rest of the time curve of these, of the VIX and its products?
Yeah, as I've been following the folks at Option Pit, they have a lot of experience in the pricing, like you're talking about, and knowing that, all right, we have 2 weeks left in this particular cycle, right before the front month VIX future expires, and so they'll say, okay, well, right now, options on this, put is cheap. It's and they just know, and it might be cheap for a few hours in the morning or something like that, and they'll send out an alert, and you may or may not be able to get that if you're paying attention, but I think that just comes from experience, and I'm sure you could write algorithms to detect when the pricing is cheap and the edge is there, but it doesn't last long.
Right. Who else has some questions? How would you suggest people start trading some volatility? What would you suggest the best way is for them just go ahead and subscribe to Option Pit?
Yeah, I mean, it was pretty generous offer there. I think it was only $100 a month, I believe, and it was you only had to commit to a quarter. So yeah, I went ahead and jumped in, and I've learned a lot. I think, and there's some great videos archived. I think anybody could learn something from it. Whether or not I continue or not is still to be determined. But I've only been following them for about 3 or 4 weeks now. So
yeah, what people can do is just send an email to Option Pit, and they'll put you on their email list, and you'll get voluminous emails, and some special offers will be included. So and you even get benefit out of just looking at the free emails, in my opinion. And there's too many of them. They send out too many, but there's a lot of good ideas there, and people shouldn't, in my opinion, reject things that are overly commercial just because they're overly commercial. You can always unsubscribe, and eventually I do, but meanwhile you can get a lot of ideas out of it.
Yeah, I'll just go ahead and show it while we're here. I have found this really valuable. This is just our website. If you just go to...
I'm not here to waste your time. If you're looking for a presentation...
if you were to get a free newsletter and then click on VIX Edge, this is the one that Sebastian puts out. And then, for instance, these are all free. You can just click here to subscribe. And then, for instance, he talks about his VIX signal quite a lot, actually. And let's see. And kind of what he sees in the market. I think it's pretty good.
Yeah, I mean, he seems to have a very high return rate, but he's had some drawdowns over the years. Has anyone else traded some volatility products? If anyone who's on the meeting here on the call, as they say, has anyone had any experience with Option Pit or with trading VIX? Not too many. Well, it's a real opportunity, and it's also a great way of hedging.
Yeah, who gave the talk a few months ago about trading longer dated options on, was it UVXY or VXX? Just purchasing a put from 6 months out or a year. Who was that?
Tom Clark, yeah.
It was Tom. Tom, yes. And that was a great talk.
Yeah, Tom trades them long term, and it was very interesting to hear that he's been making money doing that, because normally you would think, well, you're really going to pay up for the long term options, but apparently that's not the case necessarily.
Mm-hmm.
Anything else you'd like to add, Ryan?
No, I think that's it. Yeah, I just really wanted to show Thinkback because I think we haven't really talked about it before.
No.
And then this was a neat find. I'd forgotten about this particular chart, and the fact that you can add the curves was really nice. And then of course, the main thing there being the 9-day and the VVX and the VIX futures. I found a lot of value in looking at this stuff.
I mean, people really should look at the futures options because, the margin is going to be a fraction, as you mentioned, for anything like a back ratio spread. And there's no reason you can't mix. Well, there's one reason, but you can't mix some future trades in the futures option trades in the VIX with some stock trades and hedge that way. Even though you won't get a margin offset, you'll still get an account equity offset.
Yeah, and what Don's referring to is if you were to go to the in here and just trade on the futures, right? The ES futures, that by trading these as opposed to the XPX or even SPY, you're going to get much better margining.
And Iggy also trades them, and he loves them because he puts in limit orders, and he says he often gets fills in the middle of the night.
Oh, there you go. Yeah, I bet.
That he never gets during the daytime because he's got trades in all over the place. And so anyway.
That brings me to another point though, actually, I wanted to mention is commission. So commissions on these in thinkorswim are not great. There's some other, I don't know, who do you use, Don? There's great commissions on futures options.
Well, CTS,
yeah, there's a couple other brokers out there. But also, I will say that in trading the volatility products, at least the options on those products, the commissions will kind of eat you alive. They're like I said, the options, like it's already a small product, right? VIX is only at 18, and then the options are only 10x that. So, you're not. I'm used to trading SPX or options on SPX, right? And so I think if I did the math and the analysis. So far this year, all the trades in option pit, while they were very profitable, commissions took a solid 10 to 15% of those profits away.
Yeah, I'd like to have some, Tradier and some of these people have free commissions for like $50 a month or something like that. And I mean, there's very, very few of those firms, but there are one or two, and I'd like to have them talk. There's going to be limits on that, but they basically have free commissions to some extent under some circumstances. SPX is expensive actually because they have a surcharge right on the.
They do. SPX does have a surcharge. They have an exchange fee.
Yeah.
And then, but even with that, I still think you're paying less than you would if you traded SPY, for instance.
Yeah. Well, I thought that was a great talk. So anybody else have any other questions, please say so. Otherwise, did you have anything else you want to add, Ryan?
No, that's it. Thank you so much for the opportunity, Don.
Well, thank you so much for the preparation time. I know your time has a lot of calls on it. So we'll call it a night. Thank you very much for everyone. I thought this was a great meeting.